Warren Buffett didn't win because he was smarter than everyone else. He won because the game bent around him. Time slowed where he stood. Capital flowed toward his decisions before they were even made. Risk moved away from him. Quietly, structurally, almost politely. Most people study his intelligence. Very few study the system that protected it, amplified it, and removed urgency from every move he made. That difference is everything. And this is Dark Alpha, where value meets velocity. Right now, markets are obsessed with intelligence. Artificial intelligence, brilliant founders, genius investors, faster decision-making, more data, more models. The underlying belief is simple. If you are smart enough, fast enough, informed enough, you win. But history tells a colder story. The biggest fortunes were not built by the smartest people in the room. They were built by the people who designed rooms where time worked differently for them. This matters now because capital is accelerating. Information is collapsing to zero latency. Competition is no longer global, it's instant. In that environment, raw intelligence degrades faster than ever. What doesn't degrade is structure. If you misunderstand Buffett's real advantage, you misunderstand how power actually compounds in capitalism. You'll overpay for brilliance. You'll underestimate patience. You'll mistake activity for control. As an investor, that leads to chasing returns instead of owning engines. As a founder, it leads to speed without insulation. As a decision maker, it leads to pressure. And pressure forces bad timing. Buffett is often presented as a folksy genius with a calculator. That narrative is comfortable. It's also dangerous, because if his success were just intelligence, it would be replicable, and it's not. If you don't understand what really protected Buffett from error, volatility, and time itself, then you're missing one of the most important mechanics in modern capitalism. Let's strip this down. Markets are not just mechanisms for allocating capital. They are systems for allocating time, risk, and optionality. Most participants experience time as a constraint. Deadlines, quarterly pressure, margin calls, redemptions, performance reviews. Time pushes back. A small group experiences time as leverage. They are not racing it, they are shaping it. Warren Buffett belongs to that second group, but not because he discovered some secret stock formula. The core mistake is thinking Buffett operates like a traditional investor who simply happens to be better. He doesn't. Buffett sits at a structural intersection that most market participants never reach. He controls capital that is long duration, is sticky, does not flee during volatility, does not demand short-term validation. This alone changes everything. When capital does not panic, you don't need to rush. When you don't rush, mistakes drop dramatically. When mistakes drop, compounding accelerates. That is the first layer. The second layer is asymmetry. Buffett does not operate under symmetric risk. His downside is structurally capped in many deals. His upside is often open-ended. He negotiates from a position where other parties are under pressure. Regulatory pressure, liquidity pressure, reputational pressure. He doesn't predict crises. He waits for moments where the system creates forced sellers. That's not intelligence. That's positioning. And the third layer is decision filtration. Buffett does not make many decisions. He has eliminated the need to. His system filters out noise, urgency, social comparison, performance theater. What remains are a small number of high-conviction, high-impact moves. So when we talk about Buffett, we are not talking about a man beating the market with insight. We are talking about a structure beating volatility with patience. This episode is about that structure, because once you see it, you can never unsee it. Buffett's power is structural control. Over time. Here is the central idea, stated plainly. Warren Buffett's true advantage is not superior intelligence or stock-picking skill. It is his structural control over time, and time is the rarest asset in markets. Let's start with the most misunderstood component, capital permanence. Most investors manage capital they do not own. That alone creates fragility. If you manage a hedge fund, capital can leave. If you manage a mutual fund, redemptions can force selling. If you manage public perception, underperformance creates existential risk. That pressure collapses your time horizon. You might believe in a company long-term, but if the market disagrees short-term, you are punished anyway. Buffett engineered the opposite condition. Through Berkshire Hathaway, he controls pools of capital that are insurance float, retained earnings. Owner-aligned equity insurance float is particularly important. Float is capital that Buffett holds, invests, and controls, but does not immediately owe. It behaves like an interest-free loan with uncertain maturity. That means Buffett can deploy massive sums without facing immediate repayment pressure. This single feature does something extraordinary. It decouples decision-making from market timing. When prices fall, Buffett does not need to sell. He can wait. Waiting sounds passive. It isn't. Waiting is an active position when everyone else is forced to act. Here's the first reframing moment. Most people think Buffett is patient because he is disciplined. The reality is harsher. He is patient because his structure allows him to be. Discipline without structure collapses under stress. Structure without brilliance still survives. Now look at crises. In 2008, Buffett did not guess the bottom. He didn't need to. He offered capital when others couldn't. Goldman Sachs, General Electric. These were not stock picks. They were negotiated rescues, preferred shares, high yields, warrants attached, downside protected, upside preserved. This is not how retail investors operate. This is not even how most institutions operate. This is capital acting like a lender of last resort, but privately. That role only exists if you are liquid when others are illiquid. You are trusted when others are questioned. You have no short-term accountability loop. Buffett didn't predict fear. He waited to be paid for removing it. Another layer, decision asymmetry. Buffett can say no forever. There is no mandate forcing him to deploy capital by quarter end. No benchmark chasing, no fear of irrelevance. That means every opportunity competes against zero. Zero is powerful. Most investors compete against other ideas. Buffett competes against inaction. This raises the quality threshold dramatically. Now here's the deeper, uncomfortable truth. Buffett's advantage compounds because he has reduced the number of decisions where he can be wrong. Markets punish frequency of error, not just magnitude. By narrowing his decision surface area, Buffett lowers error density. This is not genius. This is engineering. Midpoint twist. If Buffett were dropped into a fast-moving hedge fund environment tomorrow, with daily P&L scrutiny, with redemption risk, with leverage constraints, he would lose his edge. Not because he became less intelligent, but because the structure that slowed time around him would be gone. That tells you everything. Buffett didn't beat the market. He built a pocket of capitalism where time behaved differently. And inside that pocket, compounding became inevitable. To understand Buffett fully, you need a counterweight. That counterweight is Elon Musk. Not because one is right and the other is wrong, but because they represent opposing philosophies of power over time. Buffett expands time. Musk compresses it. Buffett removes urgency. Musk weaponizes it. Musk operates in environments where speed is survival. He leverages extreme execution velocity, narrative momentum, capital markets tolerance for volatility. Tesla, SpaceX, and other ventures thrive on forward pressure. Deadlines are aggressive. Failure is public. Cash burn is constant. This model creates a different kind of advantage. Musk wins by outrunning competitors before constraints crystallize. Buffett wins by outlasting cycles after competitors break. Neither model is better. They carry different trade-offs. Musk's approach magnifies upside quickly, but amplifies fragility. Buffett's approach minimizes fragility, but sacrifices speed. Now notice the asymmetry of stress. When markets tighten, Musk must convince. Buffett must wait. When capital dries up, Musk raises, Buffett deploys. When sentiment turns, Musk absorbs volatility. Buffett arbitrages it. This is not personality. This is structural position. Musk lives inside time pressure by design. Buffett lives outside it by construction. Investors often confuse Musk's visible intelligence and intensity with inevitability. They confuse Buffett's calm with conservatism. But the real distinction is how each relates to failure. Musk tolerates near-term failure to achieve long-term dominance. Buffett avoids near-term failure to preserve long-term optionality. One burns capital to buy speed. The other hoards time to buy certainty. Here's the subtle point most miss. Buffett's model only works at scale. Musk's model only works with momentum. Buffett cannot operate without trust and permanence. Musk cannot operate without belief and acceleration. If belief breaks, Musk's model suffers. If trust breaks, Buffett's model suffers. That's the trade-off. Markets today reward Musk-like behavior because growth narratives dominate. But when volatility rises, Buffett-like structures regain supremacy. The danger is copying the wrong model for your position. Founders try to be Buffett without capital permanence. Investors try to be Musk without narrative control. Both fail. The lesson is not imitation, it's alignment. Power emerges when your strategy matches your structural reality. So what happens if Buffett's model continues to work? Capital concentrates, not around intelligence, but around trust, patience, and permanence. Institutions that can offer long-duration capital gain pricing power during crises. They become the buyers of last resort. They set terms. Volatility becomes an income stream rather than a threat. Markets, in this configuration, reward those who remove fragility rather than chase upside. But there's a cost. Innovation slows at the edges. Capital becomes conservative where it is dominant. Risk migrates elsewhere, often into less transparent corners. Now consider the failure scenario. What if Buffett's model stops working? This would not happen because of a bad stock pick. It would happen if trust in institutions erodes, regulatory frameworks shift aggressively, insurance float becomes constrained, capital permanence weakens. In that world, time compression wins. Speed overtakes patience. Narratives overpower balance sheets. Capital flows toward those who can adapt fastest, not those who can wait longest. This creates a different capitalism. More volatility, more cycles, more creative destruction. Who benefits? Builders with velocity, storytellers with reach, operators comfortable with chaos. Who pays the price? Pension capital, long-duration institutions, stability-oriented investors. The deeper implication is this. Capitalism oscillates between two poles. One favors patience, structure, and endurance. The other favors speed, disruption, and belief. Buffett represents the extreme of one pole. The danger is assuming that pole is permanent. It isn't. But neither is intelligence-based dominance. What persists is alignment between structure and strategy. Those who control time shape outcomes. Those who chase time react to outcomes. And over long horizons, reaction is expensive. There is a quiet assumption baked into modern markets that intelligence will always be rewarded, that better models beat slower ones, that faster thinking wins. But Warren Buffett's career challenges that belief without shouting. He didn't outthink the market, he outlasted it. He didn't move faster than competitors. He made speed irrelevant. The unsettling question isn't whether Buffett was smarter. It's whether intelligence even matters as much as we think once structure takes over. Because if structure dominates outcomes, then the future of capitalism may belong less to the brilliant and more to those who can design systems where mistakes are survivable and time is abundant. That raises a final tension. In a world obsessed with acceleration, who is quietly slowing time around themselves right now? And what will they be able to buy when everyone else is forced to sell? That question doesn't have an answer yet, and it doesn't need one. It just needs to sit with you.